You think that we can do 10% this year for equities. When does the market begin to settle down and, make back what we may lose and then get to the point where we can actually build something, put something together and get to the 10% you think equities can do?
So Scott, I go back to, when all else fails, I go back to the math. And I really think about, if you assume the economy this year is going to grow at 7+ % nominal GDP. If that's right, then corporate revenues should grow at 7+ % revenue. So you take operating leverage that companies have, stock buyback, et cetera, you can get to 12 to 15% earnings pretty readily without really stressing. I know people talk about wage costs, no doubt they're accelerating, but the operating leverage is real. Okay, so let's say that's right, but we talk about you increase the discount rates, you got to pull that back so the equity market can get you a 10, and maybe I'm wrong and it's a 7 or it's a 12, I don't know. But, I think we got to get more clarity from the Fed around this tightening. And quite frankly, it would be a lot more comfortable if some of these inflation prints, listen, the next couple inflation prints could still show some pretty high numbers. And if that's so, it's going to keep people on edge. Gosh, the Fed's behind the curve. I've got to be careful. I'm not sure how fast they're going to go. And that makes it uneasy. And that's why I talk about it's definitely not going to be a straight line there. And I think we need, and listen, I do believe that the economy is showing some signs of moderation. And I do believe that you'll see some amelioration of some of these real pressures on inflation. While it stays sticky, you're going to see it come off of these really extreme levels, and that'll give people some comfort. But I think that's going to take a little bit of time.
But see, this is one of the problems, though, right? If you say the economy, in your words, is showing some signs of moderation, even if you're coming off extraordinarily high levels, you get a Fed that is tightening aggressively, we think, into what is a slowing economy. Even if it's slowing off of a huge level, it's still a slowing economy when they're doing what they are with policy and the QT on top of it.
Okay, so let's take the starting point we're at today. We are at emergency conditions today. We're still putting quantitative easing into the system. We're just putting liquidity into the system, and we're sitting at interest rates at zero. To pull back to closer to neutral, if you get the funds rate to 1.5% and then pause and interpret what have we learned since then. We're going to get a lot of payroll reports, a lot of inflation reports. Let's reduce a bit of the balance sheet, but be very deliberate in how we do it. Let's pull back from emergency conditions. And then in an economy where potential growth is in and around 2% and real, and then if you start and it looks like you're going to have what is still sticky, but 2.5% to 3% inflation, you've got a normalized growth paradigm, but we're off emergency conditions. Boy, that is an environment I could live with, and that's an environment. But we need to hear that, and we need to see that in terms of some of the data before we can get real comfort around that. It's just the starting point today is too easy, and how we get from here to there is unclear.